Welcome, everyone. Thank you so much for joining us. Welcome to the roundtable on the future of insurance in California. Is California open for business? My name is Sam Fetchero, and I'm on the marketing team here at ZestyAI. So, before we dive into today's discussion, I wanted to take a moment to acknowledge the ongoing tragedy caused by the wildfires in Los Angeles. We are deeply heartbroken by the devastation caused by these wildfires that are still burning today. And these fires are a stark reminder of the increasing risk posed by natural disasters and the critical need for resilience. So, as California faces these challenges, our conversation today about the future of insurance in the state feels more important than ever. So let's use this time to explore how we can collectively adapt and strengthen our systems moving forward. So our goal today is not to dwell on the current impact of the fires, but to focus on how California's new regulations can address challenges like wildfire, as well as the steps carriers should take in response to climate risks and these new regulations. So with that, we have a great panel lined up for today's conversation. Mike Peterson is the Deputy Commissioner of the California Department of Insurance branch of Climate and Sustainability, where he just celebrated his 6-year anniversary there. So happy anniversary, Mike. Mike's role as Deputy Commissioner of the Climate and Sustainability branch is to develop and oversee policy initiatives related to understanding and reducing climate risk and promoting a sustainable insurance market in California. Also on our panel is Karen Collins, Vice President, Property Environmental in the Policy Research and International Division for the American Property Casualty Insurance Association, also known as the APCIA. So the APCIA is the primary national trade organization for home, auto, and business insurers with a legacy dating back 150 years. Karen provides thought leadership on property and natural catastrophe issues with an emphasis on risk mitigation and resilience and post-disaster response. Prior to joining APCIA, Karen acquired 20 years of insurance experience with several major insurance carriers in varying roles and responsibilities spanning product, sales, IT, and claims. And rounding out our panel is Bryan Rehor, the Director of Regulatory Strategy at ZestyAI. He has previously held various product management and pricing roles at Progressive and Travelers, most recently serving as Product Manager for California. He has extensive experience in collaborating with regulators, ensuring compliance, and advocating the use of AI in the insurance sector. So why is ZestyAI hosting this panel discussion? ZestyAI has always prioritized regulatory compliance as a core aspect of our business philosophy. Since day one, we've recognized that navigating the regulatory landscape isn't just about meeting requirements, it's about building trust with our carrier partners, regulators, and the communities that ultimately benefit from our models. By proactively engaging with regulators and maintaining transparency, we make sure our models are not only cutting edge, but responsible and reliable. A great example of this is ZFire, our AI-powered wildfire risk model, which was recently accepted as compliant under the California Department of Insurance's new PRID process. This means that insurers can confidently use ZFire in their rate filings today, knowing it has met the highest regulatory standards for accuracy, reliability, and fairness. ZestyAI is a property and climate risk analytics platform fueled by the power of data science. Our team of brilliant data scientists and engineers apply sophisticated AI and machine learning to vast data sets. We create both the raw ingredients that carriers use to build their own proprietary risk models and also our own peril-specific risk models to address wildfire, severe convective storms, and interior water damage. Our solutions help insurance carriers write new business with precision, refine their rating models for fairer pricing, and optimize their portfolios for greater resilience. So we're here today to continue that commitment to partnership on the regulatory front. And we see our role as a catalyst for bringing together the industry to address shared challenges. So in this spirit, we're facilitating today's conversation. So with that, to help our panelists tailor their responses to where our audience is at regarding California, we wanted to start with an audience poll question. And you'll see this question pop up within Zoom. So where does your organization stand regarding California? Are you in the process of exiting California? Maybe you're not currently writing new business in California. Maybe you're limited in writing some new business in California. Or maybe you're fully open for business. And it's perhaps this question isn't applicable to you, so we have an NA option for you. So let us know where your organization stands, and we'll reveal the results in about 20 seconds. All right, here are the results. So it looks like the plurality, almost 50% limited, writing some new business in California. We have a couple NAs there. The next is fully open for business, about 1 in 5 here, fully open for business. And then there are about 10% not currently writing new business in California. Thank you for submitting your answers. That will help our panelists really tailor their answers to where you're at today. Let's go ahead and get into our panel discussion. I'm going to stop sharing my screen so you can see us a little clearer. And the first question, maybe we'll start with Mike, and then we'll pull Karen and Bryan in a bit. So, Mike, tell us, where are we in the process of implementing the sustainable insurance strategy in California?
Thanks very much, Sam, and appreciate the chance and the invitation to be part of this panel here. Again, as many people here, we're looking at two things at the same time. Where there are devastating, tragic fires that have just occurred that my department here, the Department of Insurance, is responding to and trying to promote claims to be paid as most effectively as possible for those survivors. And at the same time, looking at implementing what is our sustainable insurance strategy that Commissioner Lara launched in the fall of 2023. And so balancing those two things, I know today is mostly focused on where we are in terms of that strategy and more looking forward. But I appreciate your note on just the devastating fires that we've seen. So I wanted to just say, at first, like, where did we start? So in the fall of 2023, Commissioner Lara launched his sustainable insurance strategy. For the majority of the year in 2024, the department did something that's never really done before, which is to work on multiple regulations all on wildfire at the same time. And so there were several public workshops, public hearings to develop regulations that included new revised regulations on catastrophe models and their use in rate filings, on the use of the net cost of reinsurance in rate filings, on what constitutes a complete rate application. And so these are all very jargony topics for the insurance sector, but they're extremely important to how we, as a sector of insurance, whether regulator or insurance company or modeler, sort of plan for the future, participate in that marketplace. Those regulatory efforts, the writing of those regulations and getting them issued in California, got completed at the end of 2024, which was our goal. And that means that coming into 2025, we shift from the writing of regulations to fully embracing that implementation mode. And so in terms of where we are, I think there's sort of 3 checkpoints that I wanted to kind of share with the audience today that hopefully gives some foundation to how to look at the next few months, the next few years. The first is that, by finishing the writing of those regulations in 2024, they've all been adopted by the Office of Administrative Law in California. It enables us to really dig into that implementation. And so on January 2nd, day after January 1st, the department was open for business with our new pre-application required information determination PRID process, which is our model review process. It was open for petitions starting January 2nd. Petitions for models to be reviewed starts a process that's laid out in the regulations that will continue for the next several months into 2025. And so that process is open and underway. There are modeling firms that have petitioned to begin that process, and that will move through over the next few months. In addition to that, the net cost of reinsurance regulations were adopted by the Office of Administrative Law. There will be further information from the department on exactly how that fits into the rate filing process. There are regulatory pieces and then there's operational pieces and implementation pieces. And so that's going to be coming in the next few months. But what we're really looking at is this is the year where these new procedures are going to be utilized. We encourage those, wherever you are in the insurance sector, whether you're a modeler or a company, to be really engaged in either petitioning for use of models or building the data and information that you need for future rate filings that include catastrophe models. And so this is a year to really move that forward. That's where we are today. It is under the backdrop of extreme wildfires in January. This is California. We have fires at different times of year, and we're going to try to do the response at the same time as we're working towards a review of these models and coming to a determination. So um, I conclude by basically saying what we announced in the fall of 2023, that by the end of 2024, we would have regulations and we move to implementation. We are on that plan as well. The sustainable insurance strategy is one that really is going to be based on getting through those model review processes and effectively using data to help inform that process going forward. So I'll pause there and pass it back to you, Sam.
Thanks so much, Mike. Thanks for setting the stage there. So let's get into these new regulations. How will they contribute to the availability of insurance? Maybe, Mike, we can start with you and then hear from Karen and Bryan.
Absolutely. By the time I pass to Karen, you'll have heard a lot from me. And so, but really, part of the sustainable insurance strategy was to pair these regulations on risk assessment tools like modeling and the net cost of reinsurance with commitments to write more policies in distressed areas of the state. And so, as we get through the process of model review and there are rate filings that include these models, insurance companies will be making commitments to write more policies in the distressed areas of the state. And so we're really trying to build that strong bridge between these risk tools and increased availability. Our hope is that with the use of more effective risk management tools, there can be writing in more areas, and we'll monitor that as it moves through over time. We believe that the commitments that fit into those rate filings are going to be effective. There are different options within those commitments depending on the size and scope of companies. I'd be remiss to not underscore what I think many people on this call know, which is that there is no monolithic view of an insurance company. There are big companies, there are small companies, there are regional companies, there are statewide companies. There are companies that just write in downtown Fresno, and there's companies that write throughout the entire Sierra Nevada. And so by providing different levels of commitment, we do intend for the companies that use these risk management tools for the first time to be committing to writing more in the areas where we've seen a retreat from in the past, and that will then provide more availability moving forward. I think it's also an opportunity. My department's over the last 5 years really built up more and more expertise on data collection and analysis, and so it does give us an opportunity to really track the changes in the marketplace in a more effective way, and hopefully see that fair playing growth level out and then reverse is our goal. So with that, I'll pass back to Sam to see if the other folks on this panel want to add to that in terms of how this will really impact availability in the state.
Let's go to Karen. What's your perspective?
Great, thank you. And thanks again for the opportunity to be here today and part of the conversation. Really to offer more of the insurer's perspective, we know in California we've had significant challenges and constraints in our regulatory process that insurers do need to follow to manage risk, including the rates they charge. When you look back to when voters enacted Prop 103, really 35 plus years ago, it was not drafted in a manner that is really well equipped to handle today's climate and economic realities, which include things like more extreme weather, rapid growth in exposures, and inflation. And when you think about in times of relatively stable trends, regulatory delays under a prior approval system might not generally be an issue, but when there are large shocks to the system, that's where our regulatory system is not well equipped. Just to give you an example, the rapid and severe inflation trends that we just saw in the pandemic, which reached upwards of 50 to 60% increase in construction costs in 2 short years before the trends slightly retreated and eventually settled out to what we're seeing now of roughly 35 to 40% cumulative increase in the last 5 years. That's significant. We've also seen these major natural disasters in recent years, not just from wildfires, actually, but also severe wind events during these atmospheric rivers and bomb cyclones that we're seeing in the state. These have contributed to a sharp uptick in costs that the majority of the industry has really needed to make adjustments and nearly all simultaneously for companies. So when you recognize the fact that we're going to continue to face more extreme climate and weather events, it's absolutely critical that companies have the ability to adjust their rates timely, but also reflect the cost of reinsurance in those rates and utilize wildfire risk models to assess their overall exposure. One of the cost factors, though, that I often see get overlooked in discussions about California, though, is also the broadening of coverage that we've seen take place under the peril of fire. In California, we've seen extensive legislation passed in recent years, well intended to help provide consumers with more protection in the aftermath of wildfires. But this has included expanded coverage benefits and also lengthier timeframes to collect those benefits, which collectively can contribute to higher ultimate severity of losses. In California, insurers also face catastrophic risk from urban conflagration fires in the aftermath of earthquakes or potential mudslides following wildfires. We've already seen a couple of those just in the last week with the recent rains. All of these factors have contributed to what we're seeing as increased volatility for the peril of fire. But our members have strongly indicated that the peril of fire, including catastrophic fire risks such as wildfire, remains an insurable peril if companies have the necessary tools to manage and timely respond to changes in overall exposure and costs. So all of that to say is that we do see these new regulations as improving availability over time as insurers have the tools necessary to manage catastrophic risk. And I do caveat this over time, as was noted, we're still working with the department to implement the regulations, including the time needed for CAT models to be reviewed and approved, and of course, those rate filings completed. So simply put, it's going to take a little time for the benefits to be realized in the marketplace. Though, good news, there's already been some evidence of favorable market response from the regulations. We have seen some public acknowledgement from individual carriers that they are ready to expand writing coverage, with one company, for example, last year having noted they would be reopened in the entire state once the regulations were available. I think another recently announced that they had reopened for homeowners business, citing the regulation specifically as a contributing factor. And most recently, another company, I think on the same day that maybe the LA fires had emerged, announced they were expanding their coverage offerings in the greater Sacramento region, including specifically Paradise, California. So this is all great evidence that, again, we are on the right track with the solutions that are needed to improve availability specifically.
Thanks so much, Karen. Let's turn it over to Bryan. What your perspective as well?
Yeah, absolutely, Sam. Personally, I think these new regulations are a game changer for the state. I mean, if you kind of look at the tools that carriers had historically to try to align risk with premiums, they had to rely on outdated methods like using the historic wildfire claims averages to justify future wildfire premiums. So that was a huge disconnect, and that's especially a challenge for a smaller insurance carrier. Let me give you an example. Say that you're a small carrier writing in the state. You may not have any wildfire claims history at all. So that means you now have to turn to the statewide average to price for your own portfolio's risks. So let's just say, I'm just going to throw a number out there. Let's say that's determined to be $200 on average. That means you're pretty much stuck as a small carrier playing in the below average to the average risk segments of the state. You're not going to want to touch the higher risk parts of the state because you wouldn't be able to justify the premiums using that historic look back period. So now carriers have the tools to price and set their statewide premiums based on the exposures that they actually expect to take on, not just statewide averages. And even better, once they establish those statewide premiums, they have tools like Z-Fire to price down to the property level and reward homeowners that are taking mitigation measures on their property. So what does all this mean? It means now carriers have the tools at their disposal to competently write risks in the state. It's going to take some time, to Karen's point. Rate filings don't happen overnight. Carriers need to kind of come up with their business strategy and how they're going to get back into the market. But what we've created now is confidence to re-enter the state and to remain in the state and continue writing business. And what does that mean? It means, more entrants into the state, carriers that have stopped writing business, or maybe they've slowed down writing business. Maybe now with that confidence, they'd be willing to write and take on more business in the state. All that means is more options for consumers.
Great. Thanks, Bryan. So let's go a little bit further and let's talk timing. And so will the California market start to soften, or do you think carriers are going to take a wait and see approach? Maybe we could start with Karen for this one and then go to Bryan.
Yeah, no, as I've shared, I think it's going to be a challenging few years for insurers. When you look at it again from an industry perspective, California's not been viewed as closed for business, but when rates do fall out of alignment with claims costs, it can result in growing losses that unfortunately can draw down the capital a company has to pay future claims. And if rates are inadequate for a long enough period, this can threaten the financial health, resulting in potential financial rating downgrades or even insolvency. And that's what we've seen in California with a couple carriers that have experienced adverse financial ratings impacts over the last couple of years. And it's still not quite yet clear what the impact is going to be from these recent LA fires, specifically on surplus capital or financial ratings, including if any insolvency concerns exist, like we saw with Merced PNC following the Camp Fire in Paradise a few years ago. So if you set aside the recent fires in LA, I think the response from carriers will likely vary based on how companies have navigated the market volatility in recent years, including their individual capital position, risk tolerance, and of course, business strategy. When you do factor, excuse me, the LA fires back into the picture, there's no doubt it could pose additional challenges and delays in rebuilding to a healthy insurance marketplace. The initial estimates that we're seeing all point to this being the costliest insured wildfire loss event in history globally. And we're also closely monitoring the impact on the California FAIR Plan, including any potential assessments and the magnitude of those. When you recognize the fact that there has not been an assessment issued by the FAIR Plan in decades, there's a bit of uncertainty related to the mechanics of that and how it might be handled, including recoupment. So naturally, these are factors that companies will need to individually weigh and consider as to when they may choose to lean into the market. As I have often highlighted to policymakers, it comes down to how individual companies are able to manage their capital, including the cost and access to alternative capital. And with 11 months to go in the year, including the more typical peak wildfire season months, it's going to be a uniquely challenging year. The bottom line is that we're really at a critical juncture for the market. We're continuing to emphasize on our end support for the reforms, obviously stabilizing the FAIR Plan, and really at the federal, state, and local level, how important it is that we rebuild stronger with improved wildfire mitigation, resilience, and disaster preparedness. And any proposals that emerge that might run counter to this could inadvertently take us backwards. But I'm very encouraged by the fact that CDI, policymakers within the state, fire officials, and the industry are all generally recognizing that these have been the shared priorities. These are the right solutions and ones that we are continuing to work towards.
Very, very nuanced perspective. Appreciate that, Karen. Bryan, anything to add on to that?
Yeah, I mean, I think with Karen, I think the market is going to soften. It is going to take some time, but I think there are some encouraging signs. So we do see some signs of action. So, for example, we see for simulation-based modelers, these are vendors that create forward-looking cat models that are used to establish statewide aggregate losses. Well, 4 of these have petitioned already to have their models reviewed by CDI. So that would be one of the first steps under the new regulations to begin using these forward-looking models in rating plans. So that's an encouraging sign. From our perspective, we are seeing a continued very strong interest in the Z-Fire product. So there's a large portion of the market today that's already using Z-Fire for rate segmentation purposes. We even know there are a few carriers that are preparing to file with these new tools. So that is a sign that carriers are thinking about the future in the state, prepping and making the investments in the tools to make sure that they're able to be profitable and successful, many years down the road. But that being said, filings take time to get approved, and even once filings are effective, keep in mind that it does take a full year for renewal policies to renew under the new rate levels. And then add on to that the uncertainty of the LA fires. We'll have to see how that overlays onto all of these other aspects. So overall, we're optimistic. We see the signs in the market that carriers are getting ready to enter back in and begin pricing risks adequately But again, it'll take some time before I think we'll start to see some noticeable changes.
Thanks, Bryan. Well, let's get practical and tactical. What should carriers be doing right now to prepare to re-enter or expand in California? Maybe we can start with Mike and then hear from the rest of our panel.
Yeah, absolutely. I'll kind of root back to a few things I said in my opening comments. I mean, there really are three major points that we're looking for this year in how our regulations are being implemented and the reaction of insurance companies and then options in the market. And that is that, are there modeling companies who are going to petition to go through the review process? And so far, we've seen some positive evidence there. Secondly, once those models are reviewed, are insurance companies putting in rate filings with catastrophe models and those commitments to write more policies. And then if those two things occur, then the third piece is evidence within the marketplace of more options for consumers. And so I think that, for insurance companies, being ready to submit those rate filings once models are reviewed and determined that they're passed sort of the integrity test, being ready to do those rate filings, being able to engage with the department through that rate filing process. That's what's going to lead to that endpoint. And I think, I'm not in the inner workings of those decisions, but if you look at where the distressed areas are and where the commitments should be made, I mean, those are areas that insurance companies can plan for and be looking at, is this an area where, my company, whether large or small, regional or statewide, looks like we can grow? Or is this an area where we were going to be growing in a different area? And so I think those are some of the strategic decisions that go on 365 days a year, but now have new risk tools to utilize in the planning for those. And so I think that really is where we are. Modelers are going through the process. Insurance companies will have that baton once those models are reviewed.
Appreciate it, Mike. Karen.
Yeah, I would agree. I think, as Mike noted earlier, in California, we really do have a number of companies with a variety of unique business models and scale, which is going to naturally have different implications in how they might move forward under the framework of these regulations. When you recognize there obviously there's an insurer commitment requirement for each the reinsurance and the catastrophe model regulations. So the first step is likely understanding for a company what is their individual market share in these distressed areas to then determine potential growth commitments. As I noted, there may be consideration that is likely needed based on the recent fires and capital position, including any impact to reinsurance programs for the remaining part of the year. The shared goal is to help carriers expand writing in the state, though. So if there are unique circumstances that might hinder an insurer commitment under the main framework of the regulation, there is the option for an alternative commitment that could potentially be proposed to CDI for consideration. Beyond that, naturally, it's very important for companies to work closely with the model vendors. This is to understand which models may undergo a PRID, and ultimately the documentation that's going to be needed for a filing itself. We have heard that some carriers are actually considering submitting placeholder filings until a complete rate filing with an approved PRID and insured commitment is known. So that is kind of an interim step, as Mike maybe alluded to, with that filing process. And then lastly, as is often the case with any shift in business strategy, companies should be keeping agents or other distribution partners updated and informed of any anticipated changes in underwriting, as that'll also be important as they get really ready to scale up.
Thanks, Karen. Let's go to Bryan. What else can carriers do right now?
Yeah, I think Karen laid the groundwork pretty well. Carriers have all the tools that they need to get back into the California market, in theory, and achieve rate adequacy. So you can now use those forward-looking catastrophe models to accurately set your overall rates. You also have property level tools like ZFire at your disposal to segment those premiums down to the individual property level. And pretty soon CDI has already laid the groundwork to incorporate reinsurance, net reinsurance costs into rates. So, California is essentially going to be on par with the tools that carriers have in much of the rest of the country to be able to support their premiums. But here's the catch. In order to use these forward-looking cat models, you do need to take on more of that market share in high-risk areas. So underwriting strategy becomes less of a lever that you have, because carriers need to be opening up, not restricting business in these high-risk areas. So to do that successfully, well, you're going to have to be able to price risks appropriately and accurately. So a tool like ZestyAI is pretty much invaluable here. So let's just say in one of these distressed areas, the average wildfire premium is determined by a forward-looking model to be $1,000. I'm just making up numbers here, but let's just say it's $1,000. Now, we as carriers know that not every home deserves to be paying $1,000. You might have a very well mitigated property that only deserves to be paying $500. Maybe there's a poorly mitigated one that should be paying $1,500. ZFire and property level tools like ZFire give you the information advantage to be able to identify these differences and price each property appropriately. So high-risk areas are opening up. Everybody's expected to play. So I think now is the time to prepare for this new reality and make sure that you're equipped to write business in these areas with the right toolkit.
Great. Thanks, Bryan. Well, we're to our last question, sort of the same question for each of our panelists, and then I promise we would have plenty of time for Q&A. So maybe we'll start with Mike. You sort of shared at the top where we are in the process. What's next from the CDI's perspective?
I think that what's next is what's always been the top priority, which is really wildfire safety. These risk mitigation tools that are going on at the home, local, state level are really the long-term backbone of a sustainable insurance market. And so we've really prioritized those in our Safer from Wildfires regulations about insurers being required to reflect home hardening attributes in how they price. We've made sure that in our modeling regulations that risk mitigation is a priority within those as well. And so we're going to continue to do that because at the end of the day, these wildfires are a part of California's history. They're a part of our future. There is research that advances every year in how to build more strongly, and we're trying to make sure that that's reflected in how we approach the insurance sector. Because ultimately, if we can address some of the risk, that provides more buffer for there to be a sustainable insurance market for consumers. And so that is, really the core issue. I also just wanted to, there's a lot of, both Bryan and Karen, you made very good points about sort of the timing of different things. One of the key things here is that once you've implemented a new system, is being able to run it and collect data around it that help you improve the system over time. And so we really are invested in having our PRID process work really smoothly and with significant effectiveness. We're going to learn from that and continue to make it better and better. When it comes to rate filings, there are new parts of these rate filings. We're invested in making sure that this system works, but we're also going to grow more effective with time. And so I think putting together those steps to learn lessons and move forward and learn lessons and move forward is really where we're putting a lot of effort. That being said, I think that wildfire risks are something that a cross-jurisdictional problem, and one of our I'd say our strongest steps is to work as a statewide official with other states and with local governments on how to get the greatest regional risk mitigation in place to have the biggest benefit to the safety of Californians.
Thanks, Mike. Let's go to Karen. What's next from the industry's perspective?
Yes, as I noted earlier, we're definitely at a critical juncture for the market. And in California, as well as other states facing increasing wildfire risk, I'm glad that Mike noted that this is really a regional issue. For California, the market's recovery certainly does depend on legislative and regulatory decisions made by officials really in the days, weeks, months ahead. But we're seeing a concerning increase in the number of conflagrations in a number of states, only amplified, of course, by the recent fires in LA, which are projected to reach upwards of 30 to potentially 50 billion in insured losses. So we simply can't continue with business as usual. Our mission, APCIA and our members, is really supporting private competitive markets to help people manage risk. So mitigation remains a very critical part of our long-term efforts to prevent events of this scale. With that in mind, we are absolutely continuing to work with policymakers on both systemic infrastructure improvements as well as regulatory improvements to solve homeowners' challenges in a constructive way that does support safety, improve affordability over time, and certainly support California's economic growth. It is critical that we partner across all of California with policymakers to help people recover, stabilize, of course, the FAIR Plan, strengthen fire mitigation resiliency, and then reform insurance regulations to help insurers as well as reinsurers in attracting new capital to continue meeting the needs of California consumers and businesses. So really, when you look at it in the near term, our immediate steps are going to be continuing to work with the department on the implementation of the regulations, but also monitoring the impact of these recent fires to determine if there might be any other action necessary, whether legislative efforts or regulatory guidance that might be needed to help ensure companies have that capital position needed to lean in. And that certainly includes us supporting reforms to ensure that the FAIR Plan itself does remain a sustainable, viable safety net for consumers in these high-risk regions.
Thanks, Karen. And let's go to Bryan. What is next?
Yeah, so I think Mike and Karen covered a lot. I want to keep this short so that we can get to questions. I think right now is the time to think about what your business strategy is in this new market. Like I mentioned, you have the tools in your toolbox to write premiums and collect premiums that are going to be adequate to be profitable. Every time there's a market in crisis, I think that does create tremendous growth opportunities. You kind of look at the state of Florida as an example. Lots of policies going into Citizens, and now even ZestyAI is talking to a lot of startup companies that are trying to get into the market and do takeouts from Citizens. So every time there's kind of this disruption, I think that creates kind of a opportunity for growth, and it's about putting together a strategy today and think about how can I potentially get some of that business. I think the companies that are going to be moving first and moving early are the ones that are going to benefit the most. So huge business opportunity. I think the other thing that I'm personally watching is the evolution of mitigation. So as many of you know, carriers are now required to offer mitigation discounts and credits to customers that perform mitigation activities on their homes. So when they went into market with these discounts, there was very little data to suggest how much of a discount is warranted for certain measures. Now that these are in place, we're going to be able to measure the actual impacts and quantify them and better improve our risk modeling, so we understand how much a Class A ember-resistant roof is actually worth and how much vegetation clearance is actually worth. So I think we're going to get better data and understand the risk of wildfire better in the state.
Thanks, Bryan. And thank you to all of our panelists. Great discussion. We covered a lot of ground, but there is still time for your questions. So I'm putting my screen back up. Now is the time to get your questions into the Zoom Q&A, and we're going to answer as many as we can. A lot of good ones have already come in. And while you're getting your questions in, we have an exclusive offer that's only available to attendees of this webinar, exclusive access to our new interactive guide, AI in Insurance, Navigating Cutting-Edge Technology and Regulatory Trends. And if you're a carrier, an MGA, we're also offering our regulatory poster sent to your office with a state-by-state rate filing laws and guide. So a great way to spruce up your office cubicle or your home office. So go ahead and snap that QR code, go to the bit.ly link, and get your copy of the guide and your free poster. All right, with that, let's get into Q&A. First one, what is the department timeline to release the list of distressed areas, zip codes, counties? Do insurers have the data on where distressed areas are so they can start planning their commitment while the models are being reviewed? That might be a Mike question.
Yeah, no, thanks for the question. Thanks, Sam. The department last June put out an initial preliminary set of distressed areas, which included zip codes and counties, based on the criteria that are in the regulations that were then later adopted in December. So that information will be updated with more recent data in the very near future. I'm not going to give a particular date, but our balance here is it's like with any trade-off. We want to use the best data we can, which takes time to vet, and we also want to get the information out as early as we can, which is to move as fast as possible. So we're managing that that trade-off, and so we'll get that out in the very near future. But the preliminary distressed areas were posted in zip codes and counties on our website last June, and they're based on information that is likely relatively consistent through the updates, but with the more refined data, it will give us a sturdier foundation to move forward on. Thank you.
Thanks, Mike. Okay, next question. I'll toss it out to the panel. This might be for Karen or Bryan. Vulnerability mitigation is important. However, would conflagration be the most important concern and response mitigation? That's the question.
Sure, and I'm happy to jump in on this. There are certainly individual parcel mitigations that are critical that you need to undertake to strengthen a home, to make it more ignition resistant. We are very, very strong supporters of the research of IBHS and their wildfire prepared framework, though their science is obviously very clear that individual structures alone is not what will get you ultimately to meaningfully bend down that risk curve. It truly does need to be community scale. Your neighbor's risk really is your risk as well. So we do need to see community scale mitigation undertaken, and that is addressed in the regulation that was adopted by the department a couple of years ago, with both recognizing parcel and community scale. And that ongoing defensible space. And I believe that IBHS is working towards as well a neighborhood version of their framework. So there's a lot of science underway, a lot of research and work towards that. From a company perspective, what we see with losses and what we're seeing with these insured losses and really the costliest losses that are emerging in recent years, these are suburban conflagrations where it is leaving the natural lands and fire spreading into the built environment and then becoming fuel that then spreads from structure to structure. And these conflagration events are what's driving the very, very significant exposure and costs associated with that fire peril, that wildfire specific peril. So we need to, and this is recognized as essentially an emergency at the federal level. This is what led to the establishment of the Federal Wildland Mitigation and Management Commission, which actually our president and CEO, David Sampson, was a member of. And there is a very extensive report that was published in September of last year that looks at the entire end-to-end cycle of fire and what we are seeing across states with wildfire. And there's a tremendous number of recommendations for individual states that they can undertake to start addressing these fuel loads so that we do prevent these community scale loss events that are occurring and the tragedy and the loss of life and the loss of property that is all associated with that. So as an industry, our primary goal is we want to bend down the loss curve, specifically really looking at urban conflagration. And so it starts at the parcel level, but it does require, again, as I mentioned, that community effort to really achieve that.
And Tim, if I might just, I don't want to step on Bryan's toes here, but I did want to just underscore, Karen bringing up this federal level wild and fire report. I think that this is the type of document that either sits on a dusty shelf or gets really utilized. And I think it's really important that it gets really utilized because there are a number of recommendations in there that take time to get fully implemented. And so starting early on, whether it's the prescribed fire that faces forest management or the community mitigation efforts, or just the local risk assessment, those are areas where, regardless of what you think is top priority or second priority, like work can be done, and it's going to end up providing a lot of benefit into the future. Because at least the way that I look at a lot of whether it's wildfire or atmospheric river is that you sort of have this continuum as you have to assess the risk better and then communicate the risk better and then reduce the risk, and then that's going to lead to a more insurable market. Some of that work just needs time to play out. And some of it actually, the hardening that happens at a home, may be an important ingredient for the mitigation of a whole community as more and more homes get hardened. And so I think that there's a lot of really good work in that report. And there's a lot of, this is not quite the right word, but sort of leveraging of individual actions into wider group actions that I think can help tackle those conflagrations that are most damaging and in many cases most tragic. And so anyway, I don't want that report to kind of skate on by. I think it is something that in your reading as you go back and forth between Harry Potter and something like this is what really is going to be effective. So
Yeah, just to add on to that, I think it's such a great question because what you do on your own property, it has definitely a huge impact on your vulnerability to wildfire, but what the community does makes such a big difference. That's part of the reason why ZestyAI models the community level risk as well as the property level risk separately. We know that there are some things that you can do to your property, and there are some aspects of the community that can lower risk. So I think the insurance industry really has, a couple of jobs to do. I mean, the first thing is we have to learn to measure these risks better. ZFire gives you a view into the difference between community and property level mitigation. And we can begin to measure and kind of identify the areas that possibly need better mitigation. But then the most important thing is not just pricing and underwriting with that information, but taking that information and building more resilient communities. So I think Palisades fire gives us a great example. I mean, unfortunately, those homes were built too densely. We know that density makes a huge impact on conflagration and home-to-home ignition. So kind of taking a step back and saying, how can we rebuild this community knowing what we know, having the insurance data, having the data from the lab, and build more resilient communities so that we reduce the chances of this happening again in the future.
Thanks, Bryan. Thank you, panel. Another one sort of on a similar topic that I'll throw to the panel. Do you recommend updating building codes to include home hardening items such as what's in IBHS Fortified, or at least offering grants to help homeowners build back stronger?
So I'm happy to jump in on this one. We are very, very strong advocates of updating building codes. Now, recognizing California's actually got some of the strongest building codes with their Chapter 7A for wildfire, and they are also working, I believe, to implement the enforcement of their new Zone 0 defensible space requirements in the state. It is going to take, in our view, a sticks and carrots approach for wildfire mitigation. There are certainly stick enforcement mechanisms. Insurance has maybe kind of fallen into the role of the enforcer with a lot of the stricter approach to underwriting, not just in wildfire areas, but really across the U.S. as we're seeing just a significant increase in natural disaster related losses, and just wanting to make sure that individual property owners are taking the appropriate steps to address what are essentially known, and correctable deficiencies that might lead to a loss. But there are a number of other opportunities with other stakeholders in what we kind of refer to as a broader property development chain. You start with the land use policymakers or policymakers that make land use decisions on where to build, and certainly the codes that will be enacted in those areas on how we build. There's opportunities for the building industry to highlight certain, more resilient features with new construction that consumers can choose to, incorporate as part of their new property types. And then there's also the financial services industry, real estate and mortgage banking, that can also create maybe incentives or other enforcement mechanisms for resilience at new construction, or even in some cases at the change of ownership. We've actually, I think, seen California already requiring defensible space inspections as part of a real estate transaction. And so there are a number of touch points that can occur that provide both financial incentives as well as enforcement. And then there's also opportunities for return on investment recognition that we can start to promote to consumers. We are, I think, as a society, very aware of what is essentially Energy Star appliances and that return on investment through lower utility bills that you expect by buying one of those. With a wildfire prepared home designation from IBHS that shows that you will be more resilient to wildfires, that should become just as commonly understood and recognized, hopefully, for consumers, and what that value will give to them through loss avoidance and expenses that might associate with having a loss. And I think that has been recognized by some of the building industry recently, as I've heard that they are, and many of the volume builders in the Western states will only build new communities to the wildfire prepared home standard. And that is excellent to see. And so we're starting to see some of this momentum that direction, but it is going to take a complete holistic effort from all of the impacted stakeholders to really get this movement towards resilience for both new communities, but also trying to help our existing housing stock come along as well and becoming more resilient for the future.
Thanks, Karen. It was great. This one's for Bryan. Will ZFire be available to individual insurance agents to look up their client's fire risk and provide them with the information?
Yeah, I think it's really a question of how does the carrier work with their agents? It's generally the insurance carrier has ZFire as a tool to underwrite or to rate policies kind of behind the scenes. So that's with a API data call approach. They also would have the tools to look up a specific property address and basically see what imagery was used to assess that property. What are the top drivers of the risk score on that property? So it's really a question of whether the carrier makes that data available to their agents. So yeah, it's not really a question for us. It's between the carrier and their distribution network on what information they give. But we do know today that carriers are required to disclose information about whatever risk scores they're using. So if a carrier is using ZFire, they have to, under state law, disclose what are the top drivers of that risk score. What was the score, how does it work? What are options that the homeowner has to potentially lower the risk score? So there's already that information being passed to the customer, and that information would be available to the agent as well via the customer notices.
Thanks, Bryan. But short, yeah, they should be sharing that information. They're certainly allowed to, and they should be. Next one, maybe we'll start with Mike on this one. If a homeowner is not in a distressed area, zip code, county, but has a fair plan policy, does that count towards an insurer's commitment, or is there any time limit on how long the fair plan policy has been in place?
Thanks for the question. So I'd start by saying, California is sort of a big, diverse state, whether that's geography, housing density. We have small towns in large counties. We have large cities in small counties. We have all sorts of different ways in which the jurisdictions are laid out. And so in the development of the distressed areas, this presents some challenges in how you look at zip codes versus counties in coming up with thresholds. And the way we approached it was really focusing on where the fair plan percentage was above a certain threshold. And so that kind of led us to where the distressed areas geographically were identified. Now, if the reduction of the number of folks in the fair plan, getting people out of the fair plan into the admitted market, is a major goal of the sustainable insurance strategy. And so to bring that into the distressed area definition, if a policyholder is in the fair plan and has moderate to very high wildfire risk, that is an eligible policy for an insurance company to use in their demonstration of their progress toward the commitment they've made in their rate filing. And so, yes, if you look at a distressed area series of zip codes and you're not in that zip code, but you're in the fair plan and you have moderate to very high fire risk, that is an eligible property. insurance companies, as they submit their rate filings, will have to keep a wildfire data portfolio in which there are policies that that demonstrate their progress toward their commitment, and that way, the department and the insurance company have a clear set of information to judge the commitment on as it progresses, and so that portfolio of data would have in it a category that was fair plan policies that have wildfire risk, even if they're not in the jurisdictions that are identified as distressed. So hopefully that answer makes sense. This is something that is laid out in the regulation in much more of the regulatory jargon, but that's the intent, is to be able to address the difficulties of a large state with lots of different densities of population. Thanks.
Thanks, Mike. There are a couple questions. There are a lot of questions sort of in a similar vein. Maybe I'll try to summarize this. If California wants to have insurance companies write more business in wildfire-prone areas, are they going to be more receptive to larger rate increases in those areas?
I think I'll take the sort of speculation out of it and say that I don't know about receptiveness. But I've been at the department for 6 years, and the premiums in wildfire risk areas have increased under the existing system during that time. And so that is an area that, because of increased fire occurrences and severity and risk, that we are already have been in for a while here. And so I do think that the sort of culture of awareness of wildfire risk has grown, and I can't speculate as to what will happen around the next bend, but I do think that whether it's local, state, or insurance regulator, we've really focused on understanding the risk and reducing the risk and trying to reflect accurately the risk in how we approach insurance. And I think that these new risk assessment tools will enable us to be more, I think, accurate and effective in that. But these rates have increased the last 6 to 8 years under the previous catastrophe adjustment system as well.
Thank you, Mike. We're at the top of the hour. I just really want to thank our panelists. Great discussion. Really appreciate the openness, honesty, handle some tough questions there. And we want to thank our audience. Thank you for attending this roundtable. So everyone will be receiving a follow-up email tomorrow with a recording of this roundtable. And we'd love to stay connected. So Mike, Karen, Bryan's contact information is on the slide. Thank you so much for joining us. Have a great rest of your day.